this is Alex with the StockMatrix program. What I could do a quick tutorial on options. I'm assuming a lot of people know what they are. Of course, assumptions are never good, right? I just went to some stock website to get so you can see the basics. Basically, a buyer has the right but not the obligation to take a long or short position in the stocks. The seller of the options have they have unlimited risk and limited profit potential because they can only make so much, right? Now, why would anybody buy a put? Well, if you think the market's topped out, and let's say you're getting a dividend and you don't want to give up that dividend, well, instead of giving up the dividend on your 200 shares or whatever you own, you buy one or two puts for the length of time that you think that the market could have little problems. Maybe it's an election deal or a corporate shakeup or whatever, right? Or war or something that you're concerned about for a bit. You can buy a put to protect that and not get out of the stock option or the stocks themselves. Now, there is a leverage play. We'll get through that here in just a second. I don't want to get too deep into the weeds. Let's see what this website else has. You buy a call, you make money when the market goes up. When you buy a put, you make money when the market goes down, right? You're betting on the downward outcome. Now, again, I'm not going to talk about selling options outright, which you can do. That's for real experienced strangle type guys that like to do that, and that's definitely worthy. But for what we're doing, we're just going to be long options, right? We're buying a call. To get out of that call, we got to sell a call. If we buy a put, we got to sell a put. So we're going to be long only on the entry, and the only time we sell is to get out. So you buy a $100 call, you got to sell a $100 call. If you buy a $100 put, you got to sell a $100 put. And that's all we're going to do. We're going to keep it simple. The whole point of this program is to keep it simple because, again, there's no other reason why anybody would, right? Now let's take a look at an example. Let me fit it into the screen here. Well, this is the S&P. Let me go to a real. There's Meta. There's Coke. Well, Coke's a good one. Everybody knows Coca-Cola, right? Well, it kind of top up here, right? Broke trend. If you had your trend lines, this and that and everything else. So, we're concerned that this was a high. You buy a put in protection mode if you've got the stocks and you don't want to get out of them. Now, if this is a new entry, let's say you don't even have it, but you're thinking Coke's going to make a top for whatever reasons. Maybe technical, maybe fundamental, but you buy a put instead, right? Well, you're playing for the market to go down, which would have been a good bet on your part. Now, the things that make up an option are main thing is the time, and the time erosion factor is pretty key, which is this right here, right? So basically 12 months ago, the last basically month is where the option really falls off. So now, some of these options have quite a bit of play time-wise. Some of them you can go out through 3 years out in the future. And again, let's go through an example of that real quick. Hang on just 1 second. Frick out of here. Let's go to, I'm going to pause it here just a second. Okay, I went to barchart.com, which is, again, just a charting company. You can actually put orders in if you get it linked up with your account. Anyway, you can, for the service, they do have some free things here, and that's kind of what we're going to look at. But you can see, this is, again, the Coke example from the bar chart. And you go to the option pricing, and you see how far out we can go for the calls and puts. They have weekly ones for the short term, maybe trading through a report, right? You don't need a lot of time or pay for a lot of time, but they go out a long ways, for crying out loud. Let's go to something that makes sense, like a 2026. That's a year into the future, 381 days to be exact. That tells you when the earnings, implied volatility, historical volatility, which is key for option pricing. But the time is the main ingredient. But again, let's do some math here. You got a $60 call, which is in the money, right? Let's say you think it's going to go up. But for $610, you can buy the ownership of 100 shares, right? So that call, you again, for every one call or put, that's 100 shares. So you're controlling 100 shares for $610. Now, if you bought the stock outright and you bought 100 shares, 62 bucks a share, right? I can do the math there, right? It costs you $6,200 versus $610 for an in the money. Now you can go deep in the money, right? And really not have that time value that's a problem. But you can buy a $50 call which is in the money $12.26, right? So $13.45. It costs you $1,345 for a call. Well, it's still a third or less, 20% of the actual cost of buying 100 shares. Now, again, the nice thing about it is you avoid gaps. You don't have to worry if World Trade Center blows up. You don't have to worry about everything. You could lose your premium. Now, with this much time, it won't, right? You'll have some premium left, a couple $100 even. But now let's look at the put side. Again, the example that we looked at was the market going down. Let me clear this out, see if the chart, yeah. That high was made on Coke at around August. So let's go back and take a look at a real example of what a $74 put cost, which would have been in the money. Now let's don't go out a year. Let's go, makes sense. Let's go to March monthly, and the puts, $75 put. Now you click here, you go to option chart. Now to get all the features on here, you have to pay for their service, but they do allow you to look at the chart. Well, there's not enough data. What a piss poor example I gave you. Anyway, let me go to less time. Let's go to the January monthly, and let's go to let's change the strikes to 20 strikes so we can get that $75 put in there, or 74, and you can see that there's none traded. So that's a damn piss poor example. I can't believe no one traded them. Let's go to, well, there's a 75, has 12. Option chart, back in August. Yeah, we're trading at $4, so $400. You tripled your money, right? And that's going out, then that would have been going out 6 months on your time. So again, it covers you, right? So again, that's the put side of things. And again, that's why I like to buy a program like I'm doing. I like to keep it into the active part. Let's pause here. Okay. Again, Coke is one of the ones that we trade. Nvidia, Meta, Coke, Google, Microsoft, Amazon, Apple, Tesla, Lynn. There's a hydrogen play. They're all ones that have traded a while, except for one, and that's coin. Because again, I wanted a Bitcoin kind of thing. My rule is you got to have at least 3-4 years worth of data to trade it accurately, right? Because I go through and do some things with time. Well, but that's the only one that I cheated on because I needed something that I could kind of Bitcoin with. Cintas, a very old company, back in the 80s. J.P. Morgan, very old company. Procter Gamble, pretty old company. IBM. So again, these are all older companies, but they do trade, right? The options have bid and offers all the time, so that's a good thing. So again, this is the Matrix Sequence program, which will start here the 6th of January. So if you're listening to it after that, this is just a brief little review on the options. Again, this is the actual stock part of it that we're basing our options on. So you have two parts to it that you'll see on X, but this is one component, and which is again the stats part of it, but then the option part of it, which will be, well, I'm actually going to put it on bar chart to keep track of it. So now let's kind of stocks real quick. And these are my charts, right? Now, again, what I do, I'm a Gann guy, WD Gann. I base everything on the quarter moon. Now, you can base it on whatever you want, right? You can do a daily, monthly, weekly. You can base it on rotation of Mercury. I don't give a shit, right? It doesn't matter. But I like the moon because it's precise. I can go way out in the future and know exactly when the next full moon, lunar eclipse, solar eclipse. I know exactly where they are. Now, I'm a big fan of solar lunar eclipses. And also this kind of year's kind of midpoint right between the two. So hopefully I don't have to explain this every time, but that's why you see this. And here's your Gann counts out to 360 divided by 8, right? So that's a year's worth. Anyway, that's why you see I have those marked out. This is the solar eclipse close, which I always watch, and you can see how the market reacts to it throughout when I go through these charts. So this is the data is derived based off this chart. Now the time, or the moons of the time, the prices are calculated based on the square of 9. So again, a Gann thing, right? I've studied Gann for 5 decades. Kind of into a little package that I can actually use, right? I used to do all the forecasting, and you'd have websites that I've have people buy stuff from. But I kind of doing that because, again, I don't need all that. Just because you predict something, you still got to make money on it, right? And Gann always followed the trend, and that's what this is designed for. Again, a little different, right? Which is good, I think. In any trading platform, you want to be a little different. And this is trading the moon. Now, I'm not precise, right? I round to the day. But again, it just gives me an idea. And I got it for this program, it has to be to change trend for me to change the direction of my trade. Right now, NVIDIA's got a put on because, again, I use threes, which again I like. So there was a put here originally, or a stop originally here, which got activated on this period, December 1st. So about a month ago, it got activated on the put, and the stops come down. We just finished up this halfway moon period, which again is basically where the risk is. So I won't buy calls now on the program until we get above that. So again, $1,300 a share or whatever it is. Let me see. Yeah, it's $134, which again, 100 shares worth is 13 grand, right? So we're buying options for $800 or whatever. So again, the leverage play is there. You avoid some of the crazy risks in some of these markets. You wouldn't think these markets would have big gaps, but some of these markets are crazy in how they gap. I'm trying to pull up a chart as we speak, one that's had a couple weird ass gaps. Adobe, which again, here a big gap here, so you got screwed, right? So if you were long 100, 200 shares of this, and all of a sudden a gap down here, you're going, what the frick, here, right? Highs and gap lower, right? So again, it must be some quarterly reports, but yeah, let's go back a ways and see how bad it was back in the beginning. Still gaps, right? Now, again, they don't look as bad because the percentages, right? We're only at 300 versus 6, but still had gaps. So, again, none of those options kind of that which keep people out, and legitimately so, right? I mean, happen. They don't have a spreadsheet. They can't calculate the quarterly. I mean, it's a quarterly report. They should know exactly where they're at. But anyway, I'm kind of digressing. So, but this is, we'll just kind of the ones, again, Meta, you can see how it had a big up and down, Coke or any Google. Now again, I pulled the data from GOOGL, which had more data back in the past. So it's a little not quite exact for my time frames, but good enough. Now Microsoft just went short. I'm in a kind of a pause for the end of the year on the program, and I won't start again until this next time period, which is January 6th. And I'll just buy stuff, like it's a new position. So that first week or two might be some losses that normally wouldn't have occurred. But, you get in somehow. But anyway, this one just went short. And so we're kind of up here, which again is not uncommon to see a high risk trade. Amazon's got a minute stop up. We've been long since September. 182 stops at 217. Now again, I'm not trying to pick anything, so I just take the data as it is. Here's Apple, stops down here. We got Tesla, which has been a wild stock, but it's been long since October at 264. So this will have a pretty good profitable trade. And again, the options made a killing. Lynn, Lynn is kind of I kind of like a logical market, but it's been getting killed, right? So again, just because I was bullish, logically, it ended up dropping, 10. So, what you think, right? Follow the trend. Here is Ed, which is, kind of another big market that's been around a long time. But you can see that made a top as well. Bank of Adobe, we kind of looked. Another one makes sense to me why it went up. with the AI thing. And the only market that hasn't made it. Back I remember going, geez, all these are making new highs. IBM isn't. Now, of course, it ended up going up. Makes sense a little bit that it had its run. Again, if you're a bull trap kind of guy, that's a little concerning. Maiden didn't follow through. Especially if you're long a lot. Again, buy a put. Here's BK and bank play, Bank Magellan. So it broke trend. Obviously, it's now short as of December 18th. Procter & Gamble went short. Again, another bull trap, a little concerning. I like bull traps and bear traps, right, to be long, and bear traps to go short. Again, I come from the commodity world, right? So, if you got to go up and down, or otherwise you won't have any trades on. Stock market people tend to be more long, the public in particular, and buying puts a little unknown to them, and a lot of your accounts won't let you sell stocks, especially in your 401ks. But if you have your options turned on, a lot of them will allow you to trade calls and puts on the long side only, which is what we're doing. So, if you're trading through your 401k, it might allow you to then go short something. Now, like I said, there's other reasons to go short, not just because some line being broken, right? But some fundamental war breaking out or something. Here's coin. Again, it's had a good move, obviously, with Bitcoin. There's Cintas. Again, my sister used to work for Cintas, and, there was going on there that was a little interesting. As it was making new highs, it just, and that's my opinion on the stock market. It's so sad that we have to fire people, lay them off, right, to keep the stocks up. Your biggest expense and training and is your employees, right? A prime example here, John Deere, experienced people, they lay them off, fire them because their stock's going down. Well, I would rather invest in a company that don't worry about the stocks. Come on. How's it all twisted up that you fire people to keep your stock up? So what? The big top people can get their bonuses? Come on. That's wrong. I'm sorry. I, Cintas is that, there are people, their bonuses that they were promised so that they could get their stock up. Well, the only people who made money in that then are the top tier people and the investors who, anyway, an interesting deal. So anyway, that's the real quick review. I know as we get going here in January, I'm going to make X kind of the platform. Go look at the trades, right? Like these, and I'll have the option trades from bar chart on there. I'll have all this data on there, and then and if that are in the moment, and then every moon period, like right here, right? We got January 3rd. I'll try to get a video updated, see where we're at, or if something really wild is happening, I'll come out with a video. I don't want to bore you to death, but again, it's more of for you people that haven't traded options, it'll give you kind of a life example. Trade it or not, it's your whatever you want with it. And there's been most of these. I've kept track pretty good. Let me see. I took bar chart off. Dang it. Hang on one second. Okay, I went back to the Coke example. Again, one of my deals is I at least want to get 60 days out, 60 to 90. So right now I'll be using March or April or May, right, depending on which monthly ones they have. Let's go to this one. That will give me 136 days, so plenty of time. And it'll be thin, right? But again, you can see the put side, and I always strike in the money. I've got simple rules, right? I go one strike in the money. I go out at least 90 days if I can, and I buy one strike in the money. And, here is the offer for a 62.50 put. Currently, the market's at 62.26. So I'll probably do a 65, but it's $400 freaking dollars, man. That's it. For 100, you control 100 to the downside. Now, of course, it's already came down a ways, which might not be a smart thing. I don't care though, right? I'm not trying to guess the market. If my chart program, it's down, I do. If it tells me it's going up, I buy calls. I don't try to overthink it. I don't worry about the economy. I don't worry about the elections. I don't worry about any of that stuff. If the market's big downtrend, we're going to catch it. If it's in a big uptrend, we're going to catch it. So, and you can, let's say it's going to be a buyer here, a 55, which is in the money quite a bit. $60 calls are in the money, $2. That's probably the one I'd pick. $2.26. The last trade was 430, but there's a bid of, which again, you'll get the offer, right? You're the buyer, so you get the worst of the two, which is the ask. Somebody's trying to sell it that. So at the worst, you're going to get it for $5.10, which is $510, controlling 100 shares to the upside. So, and you got 136 back all the way to May 16th to do something. Now, again, one of my rules is we roll. If we're in a position, let's say it turns into a bull and we bought this call and we're at 70 some dollars again, my rule is to roll 1 week into the option expiration. And again, there's bid and offers all the way out. So once we get into it, we'll kind of discover that as we again, you can see the bids and offers, right? So again, you know that there's people wanting something. I don't care what the volume is. I don't care what the open interest is. Here's an open interest in, but there's a bid and an offer, right? It's 520. Now sometimes they get a little crazy. If it gets crazy, sometimes what I do is I just put that mid price in and just put it in as a price. And now I will say I don't like waiting too long because the markets tend to gap around those moon time frames. So, all right, I'm going to cut off. This will be the first of many. Join us for the ride. Again, I did it for about 6 months. It was a positive experience on these 17 stocks. So this is the next stage. I'm going to try to do it pretty real. Again, even though most of it's fictitious for you, it'll be pretty real for me. I'm going to go through the data, take the offers, right, and best I can put the numbers up. And I actually trade this myself. Not on all of them. I don't have the money to trade it correctly personally, but I do trade a few of them. So anyway, I will let you go. Thank you and have a wonderful trading 2025 and the year.